Just 6 hours ago, Nvidia CEO landed in Japan, not to talk chips, but to secure energy for its AI data centers. Bloomberg reports he's meeting with Japanese energy officials and private suppliers, a clear sign that compute power is no longer the bottleneck. Power supply is. Meanwhile, Nvidia stock is down nearly 5% in a single trading day. So what's going on? Supply chain stress, valuation compression, or a shift in the AI narrative? In this video, we are breaking down Nvidia's first quarter in 2025 earnings and, more importantly, calculating its fair value using a case flow-based model. We will also look at the market sentiment driving this pullback and whether it presents risk or opportunity. So stay tuned. This is not financial advice. No buy, sell, or hold recommendations. Always do your own due diligence. Nvidia didn't just beat expectation, they redefined the scale of what a strong quarter looks like. In the first quarter in 2025, the company delivered a standout performance. $26 billion in revenue, up to plus 262% year-over-year and plus 18% quarter-over-quarter. Non-GAAP gross margin expanded to 78.9%, climbing more than 12 percentage points from the same quarter last year. Profitability followed suit. GAAP operating income surged plus 690% year-on-year, with net income up to plus 628%, showing powerful operating leverage. This growth isn't just visible on the profit and loss. Margins are widening, not compressing, costs remain under control. This is not a one-time spike, but a reflection of Nvidia executing at scale, with accelerating demand across multiple industries. Nvidia's strong top-line growth and operating leverage in first quarter in 2025 are also reflected in its cash generation. The company delivered a significant increase in operating cash flow, supported by both revenue performance and effective cost management. The next slide highlights how this cash was allocated and the resulting position of Nvidia's balance sheet at quarter end. Nvidia generated a record $15.3 billion in operating cash flow in first quarter, representing a plus 427% increase year-on-year and plus 33% increase quarter-on-quarter, driven by strong revenue growth and lower cash tax outflows. From this cash, the company returned $7.8 billion to shareholders, including $7.7 billion in share buybacks and $98 million in dividends. Invested $409 million in capital expenditures, including PP&E. Ended in the quarter with $31.4 billion in gross cash and $9.8 billion in debt and $21.6 billion in net cash. This solidifies Nvidia's balance sheet as one of the strongest in tech, giving it ample firepower to continue funding AI infrastructure, shareholders' return, and global expansion initiatives. This record cash generation wasn't abstract. It came directly from real demand across Nvidia's platforms. And leading that chart is the data center segment, which now accounts for the majority of the company's revenue. Nvidia's data center segment continues to be the company's primary growth engine, generating $22.6 billion in first quarter revenue, up to plus 427% year-on-year and plus 23% quarter-on-quarter. The surge was driven by rising demand for generative AI training and inference workloads on the Hopper platform, along with growth in high-performance networking. Compute revenue reached $19.4 billion, up more than 5 times year-on-year, while networking brought in $3.2 billion, tripling from last year. Supply for the H100 has improved, though the newer H200 and Blackwell chips remain supply constrained, with demand likely to exceed capacity well into next year. Yet, this exponential growth brings a new constraint: energy. Just this week, CEO Jensen Huang met with Japanese Prime Minister Shigeru Ishiba to advocate for expanded national energy capacity to support AI infrastructure. Japan, with its leadership in robotics and industrial manufacturing, is seen as a key AI development hub. But as Huang emphasized, building intelligence at a scale will require power, and lots of it. Japan now faces a strategic energy dilemma: whether to restart its post-Fukushima nuclear fleet or invest heavily in fossil fuel import, including a potential $44 billion LNG project in Alaska being discussed as part of trade negotiations with the US. According to the International Energy Agency, data center growth tied to AI is set to trigger the fastest rate of electricity demand increase in years. And for Nvidia, securing stable, large-scale power sources isn't just a logistical issue. It's a strategic requirement for global AI dominance. This energy diplomacy follows heightened US-China tech tensions, with Nvidia recently barred from selling its A20 chips to China and warning of a $5.5 billion write-down due to tightened export controls. Lawmakers are also pressuring the company to disclose chip sales in Southeast Asia. In this environment, Nvidia's strategy is clear: build resilient, distributed AI infrastructure globally, and make sure the third grid can keep up. Nvidia's gaming segment generated $2.65 billion in revenue for first quarter, up plus 18% year-over-year, though down -8% quarter-over-quarter. The sequential decline reflects seasonally lower GPU sales for laptops, which aligns with Nvidia's previous outlook. Overall, end-user demand and channel inventory levels remain healthy across the product portfolio. Market reception for the GeForce RTX 40 Super Series has been strong, backed by an installed base of over 100 million RTX GPUs. Nvidia also partnered with Microsoft to optimize AI performance on Windows, enabling LLMs to run up to 3 times faster on GeForce RTX AI PCs. Major developers including NetEase, Tencent, and Ubisoft are now adopting Nvidia ACE to create lifelike AI avatars and NPCs in games. While the spotlight remains on data center, gaming is still a critical pillar, especially as a consumer-facing entry point into AI adoption. The quarter-on-quarter decline should be viewed through the lens of product refresh cycles and seasonal purchasing, rather than as a sign of structural weakness. What's notable is Nvidia's broader positioning. Gaming GPUs are now doubling as personal AI inference engines. This shift signals a new use case beyond gaming: AI-powered PCs. According to Canalys 2024, shipments of AI-capable PCs are expected to exceed 16 million units by 2025, representing nearly 20% of the total PC market and growing at double-digit CAGR. As LLMs and edge inference becomes more mainstream, Nvidia's installed base gives it a massive first-mover advantage in consumer AI computing. In first quarter, Nvidia's professional visualization segment generated $427 million in revenue, up to plus 45% year-over-year, though down -8% quarter-over-quarter. The year-on-year growth reflects higher sell-in to partners following the normalizations of channel inventory levels, while the quarter-on-quarter decline was largely driven by desktop workstation GPU softness. Beyond the raw numbers, this segment is being redefined by generative AI and industrial digitalization, led by Omniverse, Nvidia's platform for real-time collaboration and simulation. Companies like Western have already reported up to 50% reduction in production cycle times, and 40% lower defect rates through Omniverse-powered digital twins. Meanwhile, BYD, the world's largest electric vehicle manufacturer, is using Omniverse for virtual factory planning and retail configurators. Although this segment remains smaller in scale compared to data center and gaming, its strategic importance is rising. The combination of real-time simulation, AI-enhanced design tools, and industrial digital twins position professional visualization at the intersection of AI and enterprise digitalization. According to McKinsey, digital twins could unlock over $1.6 trillion in annual economic value by 2030 across manufacturing, mobility, and infrastructure. As enterprise AI adoption moves beyond inference and into design, optimization, and simulations, NVIDIA's platform approach could give it a defensible edge, especially with partners already embedding Omniverse into their digital transformation roadmaps. NVIDIA's automotive revenue reached $329 million in first quarter, marking a plus 11% year-over-year and plus 17% quarter-over-quarter increase. The year-on-year growth was primarily driven by continued adoption of self-driving platforms, while the quarter-on-quarter growth reflects rampant AI cockpit solutions and strong momentum with global OEMs. NVIDIA supported Xiaomi in the launch of its first electric vehicle, the SU7 sedan, built on the NVIDIA Drive Orin platform. Additionally, NVIDIA secured several new design wins on Drive Thor, its next-generation centralized car computer, with leading EV makers including BYD, XPeng, GAC's Aeon Hyper, and Nuro. Drive Thor is expected to power production vehicles starting next year, reinforcing NVIDIA's position not just in autonomous driving, but as an end-to-end AI infrastructure provider for smart mobility. While still the smallest segment by revenue, automotive is NVIDIA's long-term AI bet on mobility. With over 25 million vehicles on the road expected to feature some form of AI-enabled cockpit or autonomy by 2027. Source ABI Research. The upside potential is significant, especially as software-defined vehicles gain traction. What's critical is that NVIDIA isn't just selling chips, it's building the full stack: hardware, software, insurance engines, and simulation environments. As regulatory environments evolve and L2 up to L4 autonomy scales, NVIDIA's automotive stack could become a default operating system for next-gen vehicles, similar to what Android did for smartphones. While NVIDIA has issued a strong Q2 outlook, targeting $28 billion in revenue, there are mounting external risks that could significantly impact its ability to meet this guidance. The most immediate headwind is the U.S. government's expanded restriction on NVIDIA's H20 AI chips to China, which the company warned could result in $5.5 billion inventory write-down due to canceled orders and unusable supply. Compounding this pressure, Huawei has begun mass production of its own AI chips, Ascend 910C and 920, specifically designed to replace NVIDIA's offerings in China. According to Reuters, Chinese tech giants like Tencent and ByteDance are now turning to domestic alternatives to avoid dependency on U.S. hardware. These developments introduce real structural risk to NVIDIA's growth narrative in Asia, historically one of its largest and fastest-growing markets. Combined with ongoing geopolitical uncertainty and tightening global export controls, the company's ability to deliver on its revenue, margin, and expense guidance may be more fragile than it appears. To value NVIDIA, we are using the discounted cash flow method because it fits the company's profile. NVIDIA generates massive free cash flow, has high visibility on future earnings, and isn't reliant on debt, making DCF the most suitable framework. We are not using PE or PEG ratios because they distort valuation through GAAP adjustments, stock-based comp, and we are not using PE or PEG ratios because they distort valuation through GAAP adjustment, stock-based comp, and CapEx cycles. In this first scenario, we are using a conservative free cash flow growth rate of 10% per year. The terminal growth rate is set at 2%, in line with long-term US GDP expectations. And for the discount rate, we apply a 10% WACC, which reflects Nvidia's cost of equity adjusted for market volatility and risk premium. Based on this model, Nvidia's fair value per share comes out to approximately $134. This is a base case scenario and assumes strong but stable growth without banking on the AI supercycle to deliver exponential cash flow. If you are a value-conscious investor, this sets the lower bound of reasonable expectations, not too aggressive, not overly defensive. In the second scenario, we bump up the free cash flow growth rate to 15%. This isn't wishful thinking. It's rooted in Nvidia's actual free cash flow CAGR over the past 5 years, which exceeded 70%. So 15% still keeps us grounded. With the same assumptions for WACC at 10% and terminal growth at 2%, the fair value per share rises to around $215. That's a significant premium compared to the base case, but it reflects Nvidia's potential if it maintains AI-driven growth while defending its margins and ecosystem. This model doesn't guarantee upside, but it sets a clear narrative. If you believe Nvidia is more than just a chip maker, this is what the upside could look like. If this helped cut through the noise, hit like and subscribe. We break down the market one narrative at a time.